let's continue our discussion on the investing activities section of the statement of cash flows using the indirect approach. We discussed already the loss on disposal of the planned asset because the sales amount was less than the book value. Let's look at what we purchased and what we sold. So we purchased equipment for $25,000. That's going to be a cash outflow up under your investing activity. We sold equipment for $4,000. That's going to be a cash inflow up under your investing activities. So again, we're going to have two separate transactions. We'll show the equipment purchase for $25,000 as a cash outflow up under investing. We'll show the equipment that we sold for $4,000 as a cash inflow up under our investing activities. Okay? Next, we look at our financing activities. When you think about financing, think about your liabilities section of the balance sheet as well as your stockholders' equity section. Again, on the comparative balance sheet, our common stock beginning balance was $50,000. The balance was $70,000 at the end. That means we sold $20,000 worth of common stock. That's going to be an inflow of cash used under the financing activities section of your statement of cash flow. So because again, we sold common stock, that's going to be an inflow of cash of $20,000 under the financing activities section of our statement of cash flow. More information. Retained earnings for the year increased by $116,000. You're asking yourself, what caused the increase? Well, we earned net income for $145,000, and we paid out dividends for $29,000. Now, the net income has been recorded already up on the operating activities section statement of cash flow. But we'll now record the dividends up under our financing activities. When you think about dividends, these are funds paid to the stockholders. They represent an outflow of cash, so we're going to subtract $29,000 as an outflow under the financing activities section of our statement of cash flow. Okay? Let's put it all together now. So remember, up on investing, we purchased a building for $120,000. That was an outflow. We purchased equipment for $25,000. That was an outflow. We sold equipment for $4,000. That was an inflow. So you combine those all together from your investment activities. We had a net cash used, which means a decrease of $141,000. The $120 for the building, $25,000 for buying the equipment, but then we also sold equipment. So overall, net cash used or your cash account decreased by $141,000. Now remember that overall, your beginning cash balance was $33,000 and ending balance was $55,000, right? So overall, you have an increase in cash of $22,000. You have three different types of activities. From your operating activities, there's an increase of $172,000. From your investing activities, there's a decrease of $141,000. Okay? Which leads us to our last category, being our financing activity. When we issued common stock, that was an increase for $20,000. When we paid out the cash dividends, that was a decrease for $29,000. So overall, for our financing activities, there was a net cash used, which means decrease in the amount of $9,000. So I'm writing things down as you should be as well. So from operating, You have increased 172 from operating, 172,000. Then from finance, I'm sorry, from investing, outflow 141,000. And then from financing, an outflow of 9,000. So if you take 172,000 minus 141,000 and minus 9,000, what will they give you? Drum roll, please. Yes, that gives us an increase of $22,000, which that number you knew already because your beginning cash balance was 33,000. Ending cash was 55,000. Again, those amounts came from our comparative balance sheet. So we already knew that overall cash increased by 22,000. It was a matter of showing what type of activities caused the change in our cash account. So we know that most of the increase came from operating activity, which is good, meaning that it was earned. We did acquire long-term assets, so there's a decrease of 141,000 from investment activities. We issued common stock but paid out dividends, outflow of 9,000 from financing activity. So overall, again, our overall cash account changed. It increased by $22,000. Now we have one last section or disclosure known as non-cash investing and financing activity. We purchased land for $10,000 by issuing long-term bonds. This is a significant non-cash investing and financing activity. So acquiring land would be an investment transaction. By issuing a long-term bond, that would be a financing transaction. However, in this situation, it does not involve cash. So it doesn't go up under the investing section or financing section because there wasn't any cash involved in this transaction. But this information, we do want to disclose the information. So we're going to disclose that we issue bonds to purchase land for $110,000, but it's not included in the calculations to determine our overall increase or decrease in our cash account. So there you have the statement of cash flow prepared using what is known as the indirect method. Okay? And again, here you see the statement from beginning to end. We begin with our accrual-based net income. We show the overall change from our operating activities, the overall change from our investing activities, the overall change from our financing activities. We would then indicate whether overall, if the cash account increased or decreased. It was an increase for $22,000. We're showing our beginning cash balance of $33,000 to get an ending cash balance in the amount of $55,000. So there you have, ladies and gentlemen. You now have a full statement of cash flow using what is known as the indirect method. Okay? So once again, when you prepare a statement of cash flow for comparison purposes, if compared to your balance sheet, the beginning balance on statement of cash flow must be the same as the beginning cash balance. The ending balance on statement of cash flow must be the same as the ending cash balance on your statement of cash flow. So again, I want to reiterate, you will always have a check figure because you will know the overall change in your cash account. You will know your beginning cash balance and your ending cash balance. And you will know again overall whether there was an increase or a decrease and for how much. Okay. Now this is a template that I've put on the Blackboard site under the Week 8 module to assist you prepare the statement of cash flow using the indirect method. It begins with your accrued-based net income. It shows what items should be added, what items should be subtracted to get your net cash from operating activities, investing activities, financing activities. Then show your net overall increase or decrease in cash. Show your beginning cash balance to get your ending cash balance. And then if applicable, you'll show any non-cash investing and financing activity. So again, this module is up under, or this sheet is under the Week 8 module on the Blackboard site, and you can use this as a template in preparing your statement of cash flow. Okay, now the statement of cash flow is used to determine where a company is at, evaluation. So think about a product life cycle that goes from the introductory stage over to the decline stage. And we're looking at the cash flows as being operating activity, investment, or financing. When you're first getting started, introductory, there's more cash being spent for financing to develop the actual product. At that time, the investing and operating cash flow will be smaller, but as the product grows, you're going to have more funds coming in from operating investing, and there should be less money spent on financing. So this is just showing the cash flow through the product life cycle from the introductory phase over to the decline phase for your product. Almost there. Free cash flow. This is just a ratio that shows the net cash provided by operating activities. So you look at the net cash from operating activities, statement of cash flow, subtract out any capital expenditures. That would be the acquisition of long-term assets such as building, land, machinery, equipment, etc. Subtract out any cash dividends to get what's known as your free cash flow. What is free cash? That's the amount of cash remaining after all of our expenses have been taken care of and all of our capital expenses have been recorded. So again, the free cash flow shows the cash that we have that can be set aside for investments and things of that nature. We say we pay all of our bills, we have all of our capital expenditures, paid our stockholders, we have this much cash remaining that can be used at the disposal of the company. Okay? So if you take a look at the Apple Inc. to determine their free cash flows, we will show the cash from operating activities, $59,713, less any expenditures on what we call capital expenditures, which you see for PPD was $9,571, less the cash paid out for dividends, and their free cash flow total $39,016. Okay, and again, these numbers are in millions, so you add 6 zeros to each of those numbers. One last thing, I mentioned there's two different approaches, the indirect approach and the direct approach. With the direct approach, which I will really test you on, it means we can identify every source of cash inflows, every source of cash outflows. With the direct method, it will give you the same results as the indirect method. It's just a different approach. You show all the cash inflows for operating, all the cash outflows. The investing and financial activity section is the exact same as it is under the indirect method as is for the direct method. The only thing different would be the operating activity section for the direct method compared to the indirect method. Well, that will conclude our Chapter 12 lecture. Thank you and good night.